What's up everyone, it's Karthik of Invest. Very flat to slightly down day for the markets here. Nasdaq more specifically selling off a lot more compared to the Dow Jones, which was down a little bit over 200 points on the day. And of course, Tesla here shedding once again almost $70 billion. Palantir pulling back, SoFi pulling back, Amazon pulling back, Google pulling back. There's a lot of pullbacks here across the board as the market kind of cools off after this post-election rally and the euphoria that we have been witnessing over the last 3 to 4 days. I mentioned this in our previous updates. I've talked about this over and over again, that the market's technically overbought, fundamentally expensive. However, from a sentiment standpoint, we're warm, we're not hot yet, but of course a pullback and a little bit of a correction was overdue. So markets overall, S&P 500 was down about 60 basis points, Nasdaq down over 60 basis points as well, and the Dow Jones snapping over 200 points to the downside. We did also have Jerome Powell on the day today talking a little bit about the economy, fiscal discipline, as well as interest rate expectations, inflation, economic growth, soft landing, everything. And I'm going to break down exactly what he talked about in this video as well. Not to mention inflation numbers, the PPI numbers also came out earlier today. And this right here is going to be on our MoneyVest platform. And you'll notice the PPI year over year increased to 2.4%. So that right there was the number after the CPI numbers from yesterday, which basically came on par with expectations. Producer price index, of course, coming in hotter than what the expectations were on a headline year over year basis. Month over month sitting at 0.2, which was on par with expectations here. And if you take a look at PPI on a core basis, a core PPI year over year, also coming in hotter than what the expectations were at 3.1% on a year over year basis. And of course, month over month coming in on par with expectations here at 0.3%. So PPI coming in hotter than expected here. And we also had Jerome Powell talking a little bit earlier today, talking about the economic growth being very strong. The economy is solid, and so there is no rush or no need to hurry lowering interest rates. So this economy is remarkably good. And he said, and I quote, that the strength of the US economy, the strength we are currently seeing in the economy, gives us the ability to approach our decisions very carefully. He said that the path for cutting interest rates is not a preset, and then the economy is, quote unquote, not sending any signals that we need to be in a hurry to lower interest rates. So as I mentioned before in my previous updates many times, I've talked about that the incentive for the Federal Reserve to lower interest rates is to help boost the economy and stimulate the economy, and of course make sure that it doesn't tilt or dip into a recession. That's the biggest incentive, because every time the Federal Reserve is pivoting, whether it is to a rate cut or a rate hike, they're trying to solve something. They're trying to actually solve a problem. But this time around, when they started cutting interest rates, there wasn't any problem to solve. There wasn't any problem to begin with. Economy was strong, unemployment was low, inflation was trending lower, so there wasn't really anything that they were trying to fix per se. Now, that being said, I have talked about how rates in general became way too restrictive even without the Federal Reserve even lifting a finger. How so? Well, if you take a look at inflation and how it's been trending lower, it basically came down from a peak of 9% down to about 3.3%. That's where it's sitting, right? So if you take a look at all items, CPI right now sitting at 2.6% as of the report that we got from yesterday. We were, of course, sitting at well over 9% in June of 22. If you take a look at core, which is all items less food and energy, peaked out in September 22 at well over 6.6%. It's been trending lower ever since, sitting at 3.3% as of yesterday's report. And what has the Federal Reserve been doing? They raised interest rates. They stopped in September of 23. So, basically last year, or not September of 23, I think much sooner than that. Let me just quickly double check exactly when they stopped so I can give you the most up-to-date information here. So federal funds rate, this right here is when they stopped raising interest rates. It was August of 23, not September, just 1 month earlier than what I mentioned. August of 2023 is when they stopped raising interest rates. So what happened since August of 23? If you come over to CPI, this right here is where we were, August of 23. Core inflation was at 4.4% and headline inflation was at 3.7%. Now, what happened since is, of course, all items, inflation. I'm sorry for my dog here, he's barking in the background. But headline CPI obviously came down to 2.6, and core inflation has also been trending lower, down to 3.3. And all of a sudden, you've got an economy which is now restrictive because inflation is now below the federal funds target rate, right? So which is the target rate of range of rates here set forth by the Federal Reserve. So all of a sudden, you've got a very, very restrictive economy. And now that the Federal Reserve got a restrictive economy, they really want to lower interest rates to make sure that the economy doesn't tilt into or dip into a recession. So that's what they're trying to avoid. That's the incentive part. That's what they've got now. But at the same time, they're going to stabilize at some point. They're obviously not going to lower them down to 0 or 1% or 2%. Interest rates, in my opinion, even longer term, are not heading down to those lower numbers. I think we're going to find ourselves somewhere in the mid 4s, possibly in the low 4s going into 2025. And again, depending on a lot of factors, right? If 2025 there is any type of a mild to somewhat severe recession, if the economy kind of dips into higher levels of unemployment, then yes, we can still see a possibility of lower interest rates. But until then, I think we're going to be in an environment where interest rates are going to be pretty elevated compared to what we are used to seeing from 4 years ago. So that's, really in a sort of like a summary is what the Federal Reserve Chairman Jerome Powell mentioned. And he also said, again, the recent indicators have pointed to a strong growth and stickier inflation the Fed officials would prefer, which throws into question how many more cuts or how many more moves the Federal Reserve Bank is going to make. Inflation is running much closer to our 2% longer run goal, and but it is still not there yet, and we are committed to finishing the job. So they're not done yet. It's not, calling it complete or the job's not done yet. They're still going to be focusing on lowering inflation as much as they can to bring it down to their target of 2%. And of course, President-elect Trump has been a sharp critic of Powell and the Federal Reserve and has said that he should have a say over interest rates. And Powell, whose term is extended till May 26, is determined to maintain the central bank's traditional political independence as well. So I think there's going to be a conflict between Jerome Powell and Donald Trump as well, post January 20th, 2025, once Trump takes over the White House. So we'll see what happens in 2025. I'm sure there's going to be a lot of friction. There's going to be a lot of back and forth between Jerome Powell and, of course, President Trump over interest rates. And of course, what that's going to look like moving forward. I do apologize. Again, I've got a dog here in the house who's probably going to be barking in the background. Again, hope you are not picking up too much of that through the microphone. But that, I think, are going to be my thoughts there moving forward. The portfolio scores is down a little bit over $12,000 thanks to Tesla here. So if you come over to stocks that were selling off, all in all, the S&P 500 pretty much sold off over $346 billion. Big three coming in with a $73 billion loss here. Tesla, of course, down most, $67 billion, down almost 6%, followed by Google, Amazon, Eli Lilly, Broadcom. All these stocks here selling off. And then, of course, some of the gainers. We had Apple pushing up $47 billion, Nvidia pushing up $14 billion, Microsoft was up $12 billion, Walt Disney Company, $11 billion, Chevron, Qualcomm, some of these companies pushing up here on the day. So of course, if you want access to all the trade alerts and find out exactly what we're trading on a regular basis, again, links can be down below. We'd love to have you on board. There is a 16% annual discount that's also available until the end of this month. And of course, that gives you access to the entire MoneyVest website, all the updates, trade alerts, Discord channels, weekly options portfolio updates. You can engage with over thousands of traders and investors globally as well. So links going to be down below. We'd love to have you on board. One more thing I want to mention is the markets are still pricing in for a rate cut, at least 59%. So that's where the probabilities are according to the market. So 59% expecting a 25 basis point rate cut in December. That's going to take place in 33 days, along with the summary of economic projections that we're going to get. And a whopping 41% are expecting for rates to stay steady, for us to not see any type of a rate cut or a rate hike. That is a significant number that has obviously gone up from the previous meetings that we've seen. And right now, markets are a bit of an offense here, whether we're going to get a rate cut or not. I think the next few inflation reports, as well as the unemployment numbers coming out in December, the first Friday of December, is going to be a very, very important indicator for whether we get a rate cut or not. MoneyVest index is at 3.75, so we're still in the optimistic zone here, updated just before market close. So again, markets are still pretty much in this optimism at the moment here. And then if you come over to the S&P 500, so SPX over here, coming in with a slight pullback. So as we discussed, the RSI, the MACD, again, a little bit more closer to the overbought level. So it's very normal for us to see a bit of a pullback. This is Very, very normal. The pendulum swings back and forth here. As I've mentioned this before, time and time again, as we see the markets come down, as volatility increases. So on the day, the VIX was higher, a little bit over 2%, but still pretty close to 14. So still pretty low numbers here. So we're not there yet. We're not there to a level where I can confidently say that these are buying opportunities. In other words, VIX is not high yet. Money Invest Index is not low enough, and markets are still pretty much near all-time highs. I mean, this is still not a sizable pullback or a correction just yet. Yes, we were down almost 60, 70 basis points from our all-time highs. The markets are down a little bit over 1%, but this is nothing. I mean, we're well within the dip here, because if you come over to our website and look at market snapshot, so I'm going to go over to snapshot here. Again, you can see the markets are still well within a dip here, 1 to 2% from all-time highs. And as most stocks are also well within 4 to 5% of our all-time highs right now, with a very few exceptions that are still in a pullback or a bear market at the moment. Netflix, however, continues to trade near all-time highs, continues to make new all-time highs. It's been very, very strong. So S&P 500, we got a very strong support at 5,875. So that right there is going to be that level to watch, of course, after tagging that 6,000 level. And the NASDAQ here also pulling back here very nicely. So again, nothing too crazy, nothing to write home about. This was pretty expected, and support level is going to be at 18.6. Again, RSI, MACD, L3 banker oscillator were pretty overbought here. So we're only seeing a bit of a pullback at this moment. Coming over to Bitcoin here, Bitcoin also seeing a slight pullback back under 90,000, down about 2.7%. Of course, very, very overbought at the moment. Volatility went over earlier, up over 2%, but still pretty low at over 14. So I'd still be pretty cautious here in this market environment. And if you take a look at market breadth here, of course, we had a huge jump in the percentage of stocks trading above their 20, 50, and 200 SMA, considering the post-election rally that we've seen over the last 4 to 5 days. 62% stocks now trading back above their 20 simple moving average, and we've got a 62% stocks also trading back above their 50-day moving average, and a whopping 71% still well above their long-term 200 simple moving average. So this market has been very strong. There's been a broad-based rally, however, powered mostly by tech. There's been a lot of concentration on this risk-on rally. And again, majority of stocks are participating on the way up. So that is good to see. The market's health is still pretty strong. However, given how technically overbought and fundamentally expensive we were, this is a very, very normal pullback that we're witnessing at this moment. So we did see, again, a lot of outflows from the markets today, especially when you consider the 10-year treasuries are sitting at well over 4.5%. I mentioned this, equity risk premium is diminishing. So the premium that investors are getting by investing in equities over bonds is going down. So there's no lucrativeness. I don't know if that's a word, but there's no attractiveness of investing in equities right now, given how high the yields are. So that's exactly, I think, why investors are, preferring a little bit more to the bond side over equities, and we're seeing a little bit of that pullback and outflows on the day today. So coming over to individual stocks, starting with Apple here, and Apple on the day pushing up. So there was some liquidity flooding into Apple, 1.3% higher. Support level is going to stay put at 221, resistance all the way up to $236. A lot of consolidation sideways here for Apple. Coming over to Amazon, Amazon also seeing a bit of a pullback, down about 1.2%. Support level is going to stay put at 199, closer to $200 for Amazon, and it's also been one of the best performing stocks. Very, very overbought at the moment for the RSI and the MACD as well. Coming over to Tesla, which obviously has been selling off quite aggressively, down to now under $310. This is something that we talked about in our previous updates. I was expecting this, and this is exactly why I sold calls, right? Longer dated $700 calls. I'm beating myself right now over that, because had I held it on for just one more day, those calls would have been up like 25 to 30%. That's like $2,000 to $3,000 profit instead of $1,000 that I locked in. Of course, I can't be too greedy, but that was the plan. I was kind of second guessing myself after getting a bit of a pushback in the community. And so I kind of, I was driving earlier and I was realizing this, that I should just stick to the plan. I should just stick to whatever plan I have in place and not waver from that, because it was kind of an interesting situation, because I sold the calls, got a little bit of pushback, went back, closed them out for $1,000 profit. Had I held on to it longer, it would have been a much bigger profit. So that was the original plan, to hold them for a little bit longer, because technically I was expecting Tesla to pull back here, considering how overbought it was, and it did. It was down almost 6% today. So all in all, I mean, it still came out making money, but at the same time could have been more than that. And that's the whole idea, is to maximize and optimize those trades to the best of their abilities, and let the numbers do all the talking, let the numbers do all the work. So yeah, I mean, that's where we are. Can't complain though. But so 270 is going to be that support here. We're back inside this green rectangle. As expected, it was incredibly overbought after this parabolic run up, and that's pretty normal. However, 270 is going to be that support up to as much as like around 300, low 300s. I feel like there's going to be some demand at that prices for Tesla once again. Coming over to Nvidia now. Nvidia on the day also consolidating sideways in that range. Support level 144, resistance 149. A lot of consolidation, a lot of sideways action here. If it does end up, let's say, breaking down below this, next support is going to be 136. Now, there's been some concerns over Nvidia also kind of following the fate of SMCI. I doubt it. I don't think there's going to be any fraudulent activities or anything that's kind of mark-to-market counting going on or anything shady that's going on at Nvidia. When you compare that to, let's say, SMCI, which has just been collapsing every single day, down another 11% on the day today. So, you know, time will tell, but I don't expect Nvidia to kind of follow the footsteps of Supermicro Computer. I think it's a very well run, very well managed company, but you just never know. You just never know. Anything is possible in this market. This is just a crazy, crazy market that we're seeing right now. So support level is going to stay put at 144, resistance at 149. Coming over to advanced micro devices here, and AMD continues to also pull back a little bit, trading inside this green rectangle. That's an area of support, resistance all the way up to 173. And again, a lot of demand sitting right there for advanced micro devices, down to as low as a support at 134. PayPal, on the other hand, also pulling back. It was a day where, you know, we did expect, you know, stocks were becoming overbought here. So it's very normal to see a bit of a pullback here from the market, and support level is going to stay put at $80, resistance all the way up to $85 per share for PayPal. So resistance 85, support level 81. Actually, resistance at $89, and support level is going to stay put at 81. Visa, on the other hand, Visa also trading pretty much near all-time highs, very similar to PayPal, consolidating sideways and seeing a bit of a pullback. We got a huge gap to fill here on the downside, and support level is going to stay put down to 291 for Visa as well. Talking a little bit about what is it called? Enphase. Enphase had a very nice move to the upside, pushing up over 5%. It was much higher during the day. I think it was up a little bit over 9%, validating that support here at $50 at $59. So nice little technical rebound, possibly shorts covering as well. Resistance is going to be at $73, $74 for Enphase moving forward. So nice little technical rebound after being oversold for such a long time, and of course getting absolutely destroyed over the last couple of weeks here post earnings. Costco support level is going to stay put at $920 down to $867. So those right there are going to be some levels to keep in mind. A lot of consolidation for Costco in that range coming in. So RSI, MACD, everything was overbought. We're seeing a little bit of a pullback at the moment as well. Coming over to companies like Netflix, hitting a new all-time high, very, very overbought. So I'd be very careful with Netflix here. Support level is going to stay put at 772 down to as low as 736. And then finally coming over to Meta, Microsoft, and Google. Meta here consolidating sideways as well. Resistance is going to stay put at $602 with a support level sitting roughly at 570s down to as low as 550s for Meta here. And finally, you come over to Google and Microsoft. Google here pulling back once again, getting rejected at that resistance at 183. Support level is going to step at 175 down to as low as this inside this green rectangle to as low as inside this next big area of demand and support in the 150s. However, I do think the buyers are going to step in here in the 175 range moving forward. And finally, we come over to Microsoft, and Microsoft here also pushing higher. Resistance is going to stay put at 432. Support level inside this green rectangle for Microsoft. We're just seeing a lot of consolidation for the stock right now. There's not really been any direction for Microsoft year to date, underperforming the S&P, only at 14%. So all in all, we're seeing a little bit of a pullback, which was expected on the back of a hotter than expected inflation print, as well as Jerome Powell coming in with his speech and his analysis. The economy is still too strong. There's no rush to lower interest rates. You combine that with the technical overbought levels, fundamentally expensive valuations, and we've got yourselves a nice little correction, nice little dip in the markets, but nothing to be scared of, nothing to be afraid of. This is very, very normal. We've talked about this on the channel before multiple times. It is part of the process. You're going to see pullbacks along the way. You're going to see in any type of progress, it's never a straight line up. It is always push up, come down, push up, come down, go up, come down, and it's always been like that. So take advantage of when the deals present themselves to you. I'm once again getting ready with cash, so I will be deploying a lot of cash in the coming weeks if there is any type of a sizable pullback, if the MoneyVest index comes down below 3, 2.5 or lower, and the volatility of course spikes to 20, 25, 30 levels. Again, it's a simple playbook. Nothing complicated. I really don't want to complicate it. I hate complications. I like things to be very, very simple. And that's exactly why we've built the MoneyVest website, to keep things super simple. One index, MoneyVest index, combined with market breadth indicators, technical values, entire market snapshot, fair values. Look at where the risk reward is good, deploy capital, sit back and enjoy. That's the whole idea behind the channel. Quality over quantity and keeping things very, very simple. So I hope you all enjoyed this video, found it helpful. Make sure you drop a like, subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. There is a 16% annual discount available until the end of this month. And as always, happy investing. I'll see you all in the next video. Take care.